Hi investors, welcome to this new video. And in this video, we are going to talk about gold. And sorry if the video quality is not that great because I'm traveling and just recording on my laptop. So अभी क्या हो रहा है कि regarding gold, lot of bullish comments are coming on gold, different kinds of targets which are given regarding gold. So I'll talk more about gold, the view on gold, and what is my understanding and my uh, reasons behind looking at gold in the current market. So let us start. Also, during the process, we will learn from the last 50 years of history of gold, and I will try to present some insights which I have gathered in this analysis. Standard disclaimer: as a SEBI registered research analyst, whatever we are discussing, nothing is a recommendation. I have traded in gold in last 15 days, and I do have some position. So first, let us understand through the data. Let us understand, and we'll go into last 50 years of gold data history, and we'll see how it can it help in getting some insights from active investing or trading. Uh, how we have done this? So we have taken data, trading view gold US dollar slash OZ. That is the data we have taken for calculation. We also have a data for Mumbai bullion, but the data was available only till Mumbai market data was available only from 1970 to 2013. So we have used that plus trading view this gold ticker data for all the analysis. Though we will touch upon little bit of macroeconomics. I haven't seen a lot of investing or trading success purely using macroeconomics. I mean, I haven't seen many people doing it successfully. And I myself, I believe more in the basic fundamental technical quantitative analysis. So I'll keep the macro scope limited, though I'll just present my learnings. Again, the objective is to learn the process and framework, not debate on astrological skills, whether gold will go up or it will go down. It can go anywhere and consume it in all the details because each and every detailing is important. So first question first, how is gold as an investment or trade as a lump sum amount? And if we try to find the answer might depend based on how we have experienced gold. Like if we take last 30 day of return of gold, and this analysis was done 3 4 days back, so there may be 1% of gold price movement. So 30-day return from the gold is almost 9.6%. Amazing return. If we look at last 1.3 years, 32% return from gold. Again, it looks great. But when we look at last 4 years of gold return, 6.6 CAGR, 6.6% CAGR, where in stock market, everybody has earned 15, 20, 25, 30% CAGR. So now gold doesn't look so good. And if we look at 8-year returns of gold, so all these returns is lump sum return. If you invested 30 days back and today, 1 year back and today, if you invested 8 years back and today, 9% CAGR return, which is an average kind of return. From 9, if we go 12 years back, just 1% CAGR return gold has given. Looks like a total trash asset which doesn't generate return. If we go 16 years back, 5% CAGR, which is again poor, less than FD. 21 years return of gold as a lump sum from then and today. Again, 9% CAGR, which looks like decent kind of return. Given Nifty would have given 12% kind of return. Even if we look at the gold return across the world, because then there's a point that the return is coming from INR depreciation, this, that. So I have done two things. One, I have tried to see what is the average annual return of gold versus other asset classes worldwide. And this is the return of gold, which is around 8%. And I also tried to do some analysis around INR depreciation. So we have taken from 1980 till to today, how the INR has moved, how the gold has moved, what is the CAGR of INR depreciation, what is the gold CAGR, and what is the ex INR depreciation CAGR. Now, please mind, even though we make all these statements that in future INR का depreciation नहीं होगा, तो gold का return कम होगा, ये होगा, वो होगा. I have seen very few people being accurate in macroeconomics. So I don't want to put my brains around कि INR depreciate होगा, appreciate होगा. I think it's a बहुत ही difficult होता है. It is too difficult to make such predictions. People are making such predictions from last 20 years and they have failed. Also, uh, Usually they say gold does well only when the US doesn't do well. So when US doesn't do well, we expect INR to appreciate. And there have been years when US has not done well, and that is why maybe gold did well, and still INR is depreciating. So on what basis we can make these claims? It's very difficult to say. So I want to be more technical. I want to be more quantitative. Wherever there is scope of little bit fundamental, I want to do that. But macroeconomics and using predictions ki ye hoga, wo hoga, that is the last thing I want to do. But still, I leave you with this data so that you can consume it. How is the gold return in various scenarios? And that experience of gold return in last 1 month versus last 1 year, 3 year, 8 year, all you can see here how the gold returns has come in various point of time. And that is why you can clearly see from 2011, the gold has hardly moving. So that is moving. So that is why that 1% CAGR return of gold in, 13, 14 years, because there is hardly any movement. But in last 1 year, you can see there is a movement of 30%. So all of this is captured in this chart. Little bit about macroeconomics, because I try to see if I can read some macro stuff and derive some insight of out of it. Only one basic insight I could derive from the demand supply side. So gold is produced by gold mining companies. So if there is a more supply of gold, ideally prices should decrease. If there is a more less supply of gold, then price should increase. And actually, there is some kind of correlation between gold mining supply. So gold mining supply tends to vary inversely with real prices of gold. As supply decreases, the gold prices increases, and as gold supply increases, the gold prices decreases, which holds true. So even if you have to look at some kind of correlation, macroeconomics, I think this is one good data point we should look at when we are trying to understand what drives the gold prices. Uh, so after all of this, some key insights. One, gold can have below average return even for longer duration. Like you see, gold's return in last 14 years was hardly 1% CAGR. So the long can be really longer in gold. It's not like equity where, every 5 year we should expect a great return will come, that standardized average return will come. In gold, this good or bad cycle could be much, much longer. So long-term lump sum investment return of 10 plus year also it fluctuates between 1% to 9%. And hence in gold, the entry and exit, even in the long term, it matters a lot. When we say long term, even higher than 10 years. Now, abhi tak to whatever you saw, that was more a lump sum return from 2024 perspective. Now, given this context, let us look at much broader data. And now I'm presenting you 50 years of gold data. And this might look very tiny on the screen because of the volume of the data. But what we have done here is we have taken 1971 to 2024 data, and all the rows which you see are the years 1971 to 2024. And in column also you have the same 1971 to 2024. But here we could have only 94. So in subsequent slides, you'll see 95 to 2024. I am not taking any return for 10-year duration. So 71 to 81, I am not taking. So likewise, all the zero which you see is basically that 10-year period when I'm not looking. I'm considering buy and hold gold for 10 years for that long-term investing and then see what kind of CAGR return has come. So any in between 10-year period is ignored, and then this is the return. Green means high return, red means low return. So if you see this return of gold, this return is between 1972 to 1982. This is 1972. This is 1982. This is 24%. It means between 1972 to 1982, gold gave a 24% annual CAGR return. So what is to be observed out of all of this data? I will tell you the insight. Between 1972 to 1982, the 10-year CAGR of gold was 24%. But from 1982 to 2002, CAGR of gold was minus 2%. For 20 years, gold gave minus 2% return. And that is why I said it gold long can be really, really longer. So we should have our expectations aligned from gold. अगर किसी को ये लगता है कि 10 साल में वो जो मीन रिटर्न है 7% का आ जाएगा। कभी कभी बहुत डिफिकल्ट है, नहीं आएगा, 20 साल में भी -2% का रिटर्न आया, ऐसे टाइम्स है। So if you purchased gold and held for 10 plus years and then you sold gold every year, the mean return of all the year, if you purchased in 1972 and let's say you started selling in 82 and you kept selling 82, May 83, 84, 85, the mean return of purchasing in 72 is 11%. But if you purchased in 1980 and you kept selling, the mean return is zero. If you purchased in 1993, kept selling, the return is 6%. So that is why timing and despite of long term, the returns of gold are very, very varied in nature in case you are doing a lump sum kind of investment one time. Now, 1972 to 82 was a great period for gold. 82 to 2002 was a very bad period for gold. Again, if you take 2002, 2001 to 11 cycle, again, very good return for gold. 18% CAGR for this 10 year. So almost 24% CAGR last decade of 82 to 72 to 82. Then 20 years, no return at period to period. Again, 2001 to 11, 18% return. And 2011 to 424 right now, just 3% CAGR. And if you forget this 10-20% move of last year, then this CAGR was almost 0%. No CAGR, 1% CAGR for almost 13 years. And again, if you do same kind of rollover, you purchase the gold and held it for 10 years and then sold every year. If you purchase in 2001, 11% return. And if you purchase in 2011, just 3% return. So key insight is the gold bull and bear cycle could be really, really longer. 72 to 82 is a bull cycle, 20 years of 17 years of bear cycle, again 10, 12 years of bull cycle, again 10, 12 years of bear cycle. So other thing is price drawdown is what everybody talks. Whenever we think of correction, we always think of price drawdown. But look at the type of drawdown gold has. The time drawdown is gold is really, really longer, 10 years without any return. And gold has price drawdown also. We'll talk about price drawdown, but gold may, you can have really long periods of time drawdown. And let us say if the investment goes wrong, then how much is the price drawdown in gold? That is also very high. So if you look again from 1970s and the major drawdowns, this was almost a 30% drawdown. This was almost a 48% drawdown between 1982, 85, 84. And then again from 87, another 33% drawdown. Again from 96 to 99, another 33% drawdown. And then you had this huge bull market. And after 11, this was another 37% drawdown. So in gold, from when the cycle of gold peaks or it's in the correction phase, a 30% kind of drawdown is totally possible. So the worst case price drawdown has been around 30 to 40%. Now, what does the reversion to mean principle in gold says? And reversion to mean is when we look at various asset class, we say equity में let's say 12% का रिटर्न मिलता है, रियल स्टेट में 8% का रिटर्न मिलता है, एफडी में ये मिलता है, गोल्ड में 7-8% मिलता है. But there are times also when you see it generates 18% का return. Same in equity, sometime you will see Nifty generating 20% CAGR for 3 years, and then maybe next 3 years 0% CAGR, and then average you get a 10% return. So if you consider reversion to mean is a play on asset class, which every asset class goes through, what does gold say? So again, I have done some analysis. How to read this chart is, if you purchased gold in a particular year and held it for at least 10 years, and then you started selling gold every year and kept selling every year, then what is the mean return CAGR looks like? And if you take this data, this is how the distribution of return has happened year after year. So in 1972 to 82, 10 years ke baad, very good return. Even after that, gold went down because your initial purchase price was so high that 10-year CAGR was 24%. After that, it decreased. But even from 1972, you held till 82 and you kept selling every year till 2024. Your average return would have been 8.4%. And then when you reached 1980, gold peaked and 20 years, it didn't create return. So gold ka mean return that way has been very, very less. And then again, it went on rise. So last 13 years, gold has not made money. And actually, that CAGR has come down to 1.4%. And with this, now it is rising. So this is where we are. where you can see this was one kind of worst bottom. From here, the returns were very, very bad when gold peaked. And the other time gold peak is 2011. And after that, last 13 years has been very, very bad. Here, after a bad cycle, a good cycle came. I don't know if a good cycle will come. And that is where, a lot of this analysis is, because there has been some kind of technical breakout. Everybody is talking about it. I have little bit of doubt on small cap, whether we should have all the 100% money in small cap, or we should try to diversify a little bit so that we can do some kind of volatility management by playing in different asset classes. So if we look at this distribution, we might be at the cusp of another bull run or already be in bull run. You can see this number is increasing. Only time will tell. I don't know. But this is what the reversion to mean analysis looking like right now. Now, let us say if this plays out, the question is how much gold prices can go up, and different people have different way of coming with numbers. Somebody comes with charts and drawing the lines. So if we look at history and if we look at all this data, we know gold CAGR has been somewhere between 6 to 8% after all this analysis. If you look at a 20% CAGR of the gold. Now let us imagine gold has to generate, and it's not guaranteed because you saw the 1982 to 2002, that 20-year CAGR was still bad. But I am only highlighting because if we have to look at positive angle and if we assume this cycle can play out, we don't know it will play out. But if it plays out, how much money could be made if we use all these examples? So let us say if it plays out and let us say there is a 6% CAGR to be generated between 2011 to 2031, and what return it has generated till 2024, it looks like that if we take 20-year mean return between 6 to 8%, which usually gold has given, and last 12-year CAGR has been around 1.4%. Now, to achieve this 6% CAGR in 18 to 20 years, gold might need to do some 15-20% CAGR. I don't know if it will happen or not. But if I have to find a reason why it could play out based on reversion to mean, based on what has been the average asset class return, based on whether rupee continues to depreciate, all of that, whatever we take, this might look like a possibility. Whether it will be 5%, 10%, 15%, I don't know. But if all of this plays out, this is what is possible. Now, why we are even debating and discussing that why it might play out? So, what has happened in gold? Uh, in 2020, this was the first time when gold tried to cross this level, but it failed of 2073. And in last 4 years, gold had made multiple attempts to cross this level. It couldn't cross. And after 4 years, this is a breakout which has happened on the weekly chart, where gold has broken this 4-year resistance level after multiple efforts. This year, year-wise, yearly chart, it is still progressing. And if we look at weekly chart, if you consider this as resistance, because here you have resistance, here you have resistance, here you have resistance, here you had resistance. So if you look at this point as a support, we are almost around 4%, 4, 5% far from the support. If you take this as a stop loss, or let us say it falls more, but this zone itself, because support can always not be an exact line, but it can always be a small zone also. If you see, this zone itself has been a resistance zone. If you look at this point, this point, this point, so this 2-3% could be a zone where gold may find support. The upper band of this zone is here, the lower band is here. So your support lies somewhere 5 to 8% away. So your stop loss, if you see on the weekly chart, 5 to 8% is your stop loss where it is away. So how do we deal with gold in the decision making? And I also want to highlight the annual gold price movement. So this is where we peaked around 2011. So if you look 2011 to 2024, point to point, hardly any return. This is a decade breakout, and multiple times it tried to break out little above it. It failed, and here we have a gold breakout. So if we combine all of this, we are doing a breakout in gold almost after 4 years. There is a 5 to 7, 8% kind of stop loss risk reward, which is there. It depends who wants to play how. whether first someone wants to build position or not, or build position on pullback, or keep buying equally, so that maybe if prices come down, the average price and stop loss gap becomes maybe 3-4%. I mean, one needs to decide based on the risk reward, the alternate risk reward. So the reason we are discussing is because if we have to park, and the way I do it is usually I don't look at gold. I look at gold tactically only when on technical, on charts. I have some rules for gold. Those rules are satisfied. And actually, the gold has satisfied those rules. So that is why I'm looking. The other reason why I look is, can gold become stronger than Nifty? So that is another interesting thing here. If you look at gold versus S&P, all these 20 years gold underperformed S&P, and all these 10 years gold outperformed S&P. And again, these 13 years gold has underperformed S&P. Now gold will outperform or not, and even from a Nifty perspective, because for me, gold is just a tactical bet, where can I place 5, 6, 7, 8%. And if I find the probability of a much better return in Nifty, uh, because I am a small cap investor. So if I don't find very conducive environment to put 100% in small cap, and please don't take, though I made a video last week on small cap, given all the valuations and all, but it doesn't mean I will exit small cap 100% or I will invest 100%. These are tactical bets taken in probabilities. So maybe I will be in small cap 50% or 70%. Now what I do with 30%? So maybe I'll put 20% in Nifty. Should I hold 10% in cash, or should I hold in gold? So these decisions are all relative and dynamic, which fluctuates. I might feel that, okay, I should put 5% in gold because Nifty also may not give that comfort, or maybe I might switch. So what I want to highlight is, when one wants to take a decision, these are the alternate risk reward frameworks one need to think whether I should still be in small cap, whether I should move something to Nifty, don't have anything gold, or maybe if Nifty is also not very lucrative, which I don't feel, I think still it is fair to little, 5% correction, and I think it'll look very, very fair. So we need to take care of all of this, and then based on our principles, if still it makes sense to put some money in gold, maybe we can put. But these are the things I consider while taking at these kind of decisions, and still it remains a tactical bet, where maybe at times I might expose myself to 5-8% in gold as a portfolio volatility management play with some return expectation. So that is where we are, but please take this only for framework perspective. That was my understanding of gold and whatever I have understood about gold by studying last 50 years of gold history. I will see you in the next video soon. Thank you.